Imagine this. It's a gray Wednesday morning in early 2026. You're still half asleep, reaching for your phone out of habit. The screen lights up with one notification that stops you cold. Not a work email, not a bill reminder. A simple bank alert. $5,012.47 deposited. No explanation needed. It's the same deposit that arrived last month and the month before. No client call, no invoice chase, no weekend grind bleeding into your sleep. Just money showing up, quiet and consistent, like gravity pulling water downhill. Most people would see that scene in a YouTube thumbnail and think, clickbait, only possible for trust fund kids, crypto lottery winners, or people who already have millions. But here's the sharp, uncomfortable twist that actually lands like a slap. In 2026, with inflation still quietly eroding 3 to 3.5% of purchasing power annually, AI automating away chunks of white-collar work, interest rates stabilized but volatile, and geopolitical headlines keeping markets on edge, $5,000 monthly in truly passive income is no longer reserved for the 1%. It's achievable, not easy, not fast, but mathematically possible for disciplined average income people in the US, UK, and Canada who start now and refuse to quit. The catch that stings? The reliable paths to get there are intentionally boring. They don't make good TikTok reels. They don't promise 10x in 90 days. They reward patience, consistency, and a willingness to ignore noise, while the rest of the internet chases the next viral hack that usually ends in losses or burnout. Why does this feel urgent in 2026? Let's be brutally clear. The traditional safety nets are fraying at the edges. Real wages for middle earners in the US, UK, and Canada have barely budged in real terms since the mid-2010s when you adjust for inflation and housing costs. Company pensions? Mostly gone outside legacy public sector roles. Government retirement systems, Social Security in the US, state pension in the UK, CPP, OAS in Canada are solvent, but increasingly inadequate on their own. Add in longer lifespans, people living into their 90s is now normal, rising healthcare costs, and the very real risk of job displacement from automation, and suddenly the idea of relying solely on a paycheck feels like walking a tightrope without a net. Passive income flips the equation. It turns your capital into a silent employee that works 24/7, 365. Your money earns while you eat breakfast, while you're on vacation, while you're sleeping through a market dip. In an era where control feels scarcer every year, layoffs announced to be a Zoom, rents spiking overnight, grocery bills creeping up, passive income is one of the few levers left that you can actually pull yourself. So how do you build it without touching real estate? Too much hassle, illiquid, local market risk. Or crypto, too speculative, regulatory whiplash, 80% drawdowns. Let's walk through the 4 main realistic paths in 2026. No exaggeration, no guru promises, just the mechanics, the math, the timelines, the hidden traps, and the psychological walls most people hit. Path 1. Dividend stocks and dividend-focused ETFs, the quiet compound machine. This is the backbone for most people chasing meaningful passive cash flow. Dividend stocks are shares in established companies that distribute a portion of profits back to shareholders regularly, usually quarterly, sometimes monthly. We're not talking speculative growth stocks that might pay a dividend someday. We're talking aristocrats and kings, companies with 25+ or 50+ years of consecutive dividend increases. Examples in 2026 still include names like Procter & Gamble, consumer goods you use every day, Johnson & Johnson, healthcare staples, Coca-Cola, PepsiCo, Realty Income, monthly dividends from commercial properties, but we're using it as a stock, not direct real estate, 3M, Emerson Electric, and dozens more. Instead of picking individual stocks, which requires research and carries single company risk, most smart builders use low-cost ETFs that bundle these reliable pairs. Top choices right now: Vanguard Dividend Appreciation ETF, VIG, focuses on companies with 10-plus years of dividend growth, yield around 1.8 to 2.2% in 2026, but total return, dividends plus price growth, historically averages 8 to 10% long-term. Schwab U.S. Dividend Equity ETF, SCHD, higher current yield, 3.2 to 3.6%, tracks Dow Jones U.S. Dividend 100 Index, very popular because it balances yield in quality. Spider S&T Dividend ETF, SPDR, aristocrats only, 25-plus years of increases. How the cash flow actually works? You buy shares, the companies earn profits, they send you cash, or reinvest if you choose. In a taxable account, you get the money deposited. In a tax-advantaged account, IRA, ISA, TFSA, it compounds tax-deferred or tax-free. The math tension starts small. Invest $10,000 in SCHD at 3.4% yield. That's $340 per year, about $28 per month. Feels laughable. But turn on dividend reinvestment, DRIP, those $340 buy more shares. Next year's dividends are on a bigger base. Add fresh contributions monthly. Compound at a 7 to 9% realistic total return over decades, and the snowball effect becomes visible. Real example timeline: a 28-year-old in 2026 starts with zero, invests $600 per month, aggressive but doable by cutting lifestyle inflation, assumes 8% annual return. By age 45, 17 years later, roughly $250,000 portfolio. By age 55, around $650,000. By age 65, around $1.6 to $1.8 million. At a safe 3.5 to 4% withdrawal rate, that's $4,600 to $6,000 per month passive, close or exceeding the target. The irony? This path feels slowest at the beginning, when people most want quick wins. Yet historically, it's one of the few that survives crashes, 2008, 2020, 2022, and still delivers over 20 to 30 to 40-year horizons. Path 2. Fixed income, bonds, bond ladders, and preferred shares. The boring fortress. Bonds are loans you make to governments or corporations. They pay interest or coupon in return principal and maturity. In 2026, after the wild rate swings of 2022 to 2024, yields are more attractive than the near-zero era. Key options: U.S. Treasury bonds or notes, 10-year around 3.8 to 4.2%, ultra-safe. UK gilts, similar for longer terms. Canadian government bonds, comparable. Investment-grade corporate bonds, 4.5% to 5.5% for high-quality issuers. Preferred shares, hybrids between stocks and bonds, often 5 to 6.5% yields, quarterly payments from banks, insurers, utilities. Strategy: build a bond ladder. Buy bonds maturing every 1 to 2 years so you're not locked into low rates forever and can reinvest at higher ones if they rise. Or use bond ETFs or funds for simplicity, like Vanguard Intermediate Term Corporate Bond ETF, iShares Core US Aggregate Bond ETF. $150,000 ladder at average 4.2% yield, around $6,300 per year, or $525 per month. Safe, predictable, low volatility compared to stocks. The absurdity? In a social media world obsessed with high-yield everything, the lowest drama asset class often preserves capital best during recessions. 2008, stocks down 50%, treasuries up. 2022 rate hike pain, bonds hurt temporarily, but holders who held to maturity got par back plus coupons. Path 3. Peer-to-peer lending and private credit platforms, becoming a mini bank. Platforms like Lending Club, Prosper, US, Funding Circle, UK, Canada Focus, or newer private credit funds let individuals lend to consumers or small businesses. You earn 5 to 8% average returns after defaults and fees. Realistic net in 2026. Mechanics: deposit money, Algorithm or manual selection spreads it across hundreds or thousands of loans. Borrowers repay principal plus interest monthly. Platform handles collections. $75,000 diversified? Historical nets suggest $3,750 to $5,250 per year. Possible, though defaults rise in recessions. 2020 saw spikes. The strange psychology? You're profiting from someone else's debt while your own cash sits idle, earning more than a high-yield savings account, which might be 3 to 4% in 2026. Risks? Platform bankruptcy, rare but possible. Higher defaults and downturns. Illiquidity, can't always pull money instantly. Path 4. Digital and intellectual property assets. Create once and earn indefinitely. For those with expertise or willingness to learn, create assets that